Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. America's economic dynamism, deep capital markets, and stellar equity returns have long made it the top destination for capital. But with US stocks, Treasuries, and the dollar all sliding together, cracks are appearing in the image of American exceptionalism.
Could mounting chaos really lead investors to turn away from Uncle Sam? And in today's dumb question of the week, we ask, why would you ever buy another country's bonds? All right, let's get into it. So last week, we saw something quite unprecedented in markets. Stock market volatility spiked. If you look at the VIX, it's the highest since the early days of the pandemic. And usually, when volatility goes really high in the stock market, people would seek safety, which means that Treasury yields would fall as people buy US government bonds. That didn't happen. The opposite happened. US 10-year yields went up. And usually when that happens, you would expect the dollar to rise as higher rates in the US attract capital. But that didn't happen either. The opposite happened. The dollar weakened. Roman, what's going on?
I think that's what shocked people. This wasn't your usual sell-off. This was a very, very, very scary sell-off because there are certain safe haven investments, and the US is usually the bastion of safe havens, both the dollar and US Treasuries. Not so this time. So it seems as if people have lost faith in US Treasuries, they've lost faith in the US dollar as a safe haven, a safe place to put your capital. And that's a complete reordering of the safety trade, if you like, globally. And people are probably looking for other safe havens now.
Unusually, the yield on German bonds fell at the same time as Treasury yields rose. And that's quite unusual because usually you would think developed market government bonds are quite tightly correlated.
Yeah, normally what would happen is that the Treasury market would rally, the prices would rise, the yields would fall as people seek safety. And you'd see the same behaviour in bonds and to a lesser extent in gilts, because those are all seen as safe places to park your capital.
And I think for context, what's important is not the absolute level of yields in the US, which aren't anything particularly exceptional. It was the speed of the sell-off in Treasuries. So the 10-year Treasury experienced its biggest three-day sell-off since 2001, where yields went from below 4% at the end of the previous week to more than 4.5% by Wednesday. Is 0.5% really scary?
Oh, that's absolutely huge for the 10-year bond. Yeah, I mean, that's a huge move. So it might not sound like much when you compare it to daily moves in equity markets, but for the bond market, that is cataclysmic in terms of its speed.
And it wasn't just the 10-year, was it? The 30-year yield rose sharply as well. And if you look at real yields, the 30-year real yield is actually at the highest level since 2008.
Now, lots of people have been talking about the Trump put. In other words, that if markets sold off, equity markets, at a certain point he'd roll back the tariffs. Now, it looks like he was willing to suffer quite a lot of pain in equity, but it turns out that for bond markets, not quite so much. So here's a nice quote from Edgar Daney, who owns a research outfit in the United States and publishes great graphs. Thank you, Ed. He says, the bond vigilantes have struck again. As far as we can tell, at least with respect to the US financial markets, they're the only perfect hitters in history.
So it's a baseball analogy, right? Every time the bond market swings for the fences, it gets a home run. And here, they wanted Trump to change course, and he did.
So what we've seen really is very important because it shows that the Trump presidency might be slightly insensitive to equity markets, but when it comes to the bond market, because that's used to fund the government, that's going to keep the policies under control. So while the system of checks and balances seems to be a little bit wobbly at the moment, it seems as if the bond market is ensuring those checks and balances.
Yeah, when the bond market decides not to write checks and to throw things out of balance, you're in trouble. It does for politicians again and again, doesn't it?
Yeah, it certainly reminded me of what happened with Liz Truss. And everyone has been throwing around the quote from James Carville, which is, I used to think that if there was reincarnation, I wanted to come back as a president or the Pope, or as a .4 baseball hitter. But now I would like to come back as the bond market. You can intimidate everybody.
I'd be interested to know what the feedback mechanism literally was with Trump. Does he really understand the bond market? Maybe he does understand yields, given he was a real estate developer.
This is it. He's really sensitive to interest rates, which is why he's always talking about what the Fed's doing. So I think he really does understand the importance of having low interest rates for the US economic model and for growth in the United States.
But you don't want to see a sell-off in all US assets at the same time, which is kind of what we have seen. There was a quote doing the rounds from a high-profile analyst at Deutsche Bank, George Saravalos. I'll just read it to you now. We've been warning about a confidence crisis in the dollar for more than a month now. We are witnessing a simultaneous collapse in the price of all US assets, including equities, the dollar versus alternative reserve FX, and the bond market. We are entering uncharted territory in the global financial system.
So I think that's true. I think this is one of those inflection points when the perception of the US has changed. Maybe not irreversibly. I'm not convinced that the US isn't going to go back to being a safe haven and also a very good source of long-term return. But what this has done, I think, is shaken people's belief that it's always going to be a safe haven.
Does the fact that Treasury prices fell at the same time as the dollar weakened indicate that overseas investors, like foreign buyers of Treasuries, were pulling back?
Yeah, I think so. I think that's definitely one source of it. But also domestic investors. If you look at the ownership of US Treasuries, it's primarily domestic institutions in the United States, but also mom and pop, just regular people buying their own government debt.
But that wouldn't weaken the dollar.
No, it wouldn't. And that is worrying, the fact that people have lost faith in the dollar. And I think that's also institutional money, which is going to dominate those flows. So why did people do it? Well, if you're a fund manager, you're probably thinking, well, this is a country which I could trust to always put business first. And yet what we're seeing right now are policies which are going to hurt business, no question, where they are willing to put the US into recession in order to achieve a not very clearly defined goal.
And it's the fact we've got these constant moves in policy, huge moves in trade policy. How can anyone plan in that kind of situation, right? If you're trying to spur domestic investment, that's not the way to go about it. Like we said earlier on, the VIX has spiked, which is the Wall Street fear gauge, showing that people are expecting a lot of volatility over the next month. But we put in the weekly newsletter, didn't we, that VVIX, which is another kind of measure, one step removed, like the volatility of volatility, is at its highest level ever. And by quite some distance. I think that's the thing with Trump. He's so volatile that you don't even know what to expect from his volatility.
Yeah, we're uncertain about the uncertainty. But imagine that you're someone working in one of these customs offices on a dock, having to think, well, what's the tariff on this now? It's just changed from yesterday.
Got to check Truth Social, haven't you? See what Trump's posted. But did you see there was stories over the weekend that actually the US is not collecting any tariffs at the moment? They somehow messed up the codes that track different goods, and they just have to wave stuff through without charging tariffs.
But going back to the volatility of the Treasury market, I think another cause of that has been people unwinding the basis trade in Treasuries, which very simply is when you trade the futures market for bonds versus the cash market for bonds. So let's say you buy a 10-year Treasury, you sell it forward in the futures market, and then you bag the difference between the price of those two things levered up. Now that all works fine until you get huge volatility in the Treasury market. Then you have to post more margin against the increased volatility. So you have to sell something and you get this kind of downward spiral because you're probably going to sell some Treasuries to fund it.
I think that's the thing with volatility that people misunderstand. I think instinctively people just think, oh, it's markets, they do their thing. At some point they're going to get shaky and it's scary, but you just hold on, it doesn't really matter. But for these underlying trades which provide the liquidity, volatility really matters. It makes everything more expensive to hedge and means that some trades become unprofitable, which then get unwound and increases the volatility further. And you can get this kind of domino effect where volatility breeds more volatility.
Like we saw with the LDI stuff in the UK, the liability-driven investments, where you had lots of interest rate swaps, where you had to post more margin, and that led to this runaway effect. So if you shake the tree, bad stuff happens, and it's usually because of leverage.
And shaking the tree really hard can cause correlations to break. Like obviously we've seen that where treasuries and stocks are moving in opposite directions, but also with the dollar as relates to treasury yields. I saw a great graph in the FT where they plotted the US dollar index, which is how strong is the dollar against other currencies, and overlaid on it the 10-year Treasury yield. And they track each other almost perfectly, almost all of the time. But then, just over the last few weeks, they've diverged massively. So this is what we said, the dollar has weakened sharply at the same time as the Treasury yield has surged, which is very unusual.
So I think the narrative's changed here. We've gone from a narrative in which there is no alternative to the United States. Everyone was talking about TINA before this, Liberation Day. Now we're talking about the Sell America trade, which is a 180-degree turnaround in narrative.
Yeah, it is a crazy shift. And I think they kind of had it coming. There was a great quote from Brendan Greeley in the FT where he said, "Any country other than the US precipitously raising and lowering tariffs, gutting its internal revenue service, and nonchalantly considering territorial grabs would have seen smoking hot capital flight months ago."
And again, I'd remind people that we're just 3 months into this presidency, and this is what we've seen in markets, which react very quickly. Now, what we haven't seen yet is a huge softening of economic numbers coming out of the United States, because often those are published with a lag. So perhaps it's the case that they won't get worse now, but we're not going to find out for some time.
Some of the so-called soft data has started to weaken quite significantly. The University of Michigan has their survey of consumers, which looks at what do people expect to happen with inflation in the future and what do people expect to happen with growth. And one-year inflation expectations have absolutely soared to nearly 7%, which is the highest reading since 1981.
Yeah, that is shocking. Now, the Federal Reserve will be watching that very closely. You'll often hear them talk about anchoring, which is where people expect inflation to move, because once those inflation expectations become unanchored, once people think that inflation is going to spike, it becomes self-perpetuating. So the Fed's really worried about that, because that makes a transient increase in inflation something much more sticky.
From this same survey, consumer expectations for inflation, even 5 to 10 years ahead in the future, have spiked to 4.4%. So that's more than double the Fed's target. Now, I think this survey is not the thing that the Fed really focuses on when it looks at inflation expectations. They look at what's priced into markets more, I think.
They certainly do look at business surveys and they look at consumer surveys, because those control human behaviour. And that's what you pay attention to if you're worried about anchoring.
This same survey also showed that growth expectations have weakened dramatically. And respondents to the survey actually expected greater unemployment in the year ahead, to the highest degree since 2009.
And another critical market which the Fed monitors carefully is the credit market. And if you look at consumer loans in the United States, the defaults there have started to rise quite sharply. Now, this did come off a low base, at least that's what we were saying previously, but now it's gone beyond that low base and it's above where it was pre-pandemic. So that is worrying. And if it continues, then it's going to become a problem for banks and bad loans.
Yeah, I saw that JP Morgan has said that the proportion of its credit card loans that are deemed unrecoverable is now a 13-year high. So there's lots of warning signs out there. And you have seen American investment banks raising the odds of a US recession.
Yeah, Goldman stepped back from the 60%.
I saw that, yeah.
And that's once they rolled back the reciprocal tariffs.
I think their forecast of a recession lasted about an hour or two before they were forced to step back. I say forced, I think other banks haven't rode back.
And that's a really important point, which is that the source of uncertainty is still there. A very uncertain economic policy, but also uncertain trade policy.
So we're seeing the soft data weaken sharply. When will that feed through into the hard data, if it does? What will be the first things to move?
Well, the monthly data are the ones which will show us any kind of problems. So payrolls in the United States is often seen as a bellwether for the broader economy. If we start seeing people losing their jobs, then non-farm payrolls will fall. And that's usually a fairly good early warning signal.
What was interesting about that non-farm payrolls data? Well, I was like, where's all these Doge cuts? Why is this not showing up? And do you know what it is? Is that the way non-farm payrolls is calculated is if you're being paid a severance package, you're not counted as unemployed yet.
I think what people don't appreciate is that government employees don't make up a huge proportion of US employees.
So you'd expect the payrolls number to move at some point if we are going to get a recession. It's kind of defined in the US by a pickup in unemployment. Is there anything that might happen sooner than that? Like somewhere between the soft data and the hard data?
Yeah, the PMI index might be something to watch here because that's published every month. And there they poll purchasing managers at companies in the United States. And they ask, how's the business outlook looking for you? And they collate the answer and come up with some kind of diffusion index. Greater than 50% is improvement, less than 50% is worsening. And that sits in terms of frequency, which is monthly, somewhere between soft and hard data.
So what would we call that? Al dente data?
Squidgy. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple? You can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 0.5% cash back on all transactions up to £20 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
So in recent weeks, Romin, we've seen a flood of articles in the media from commentators and opinion writers and polemicists making the point that this could mark the end of American exceptionalism. Now, before we get into whether it's the end of it, I kind of want to ask, is America exceptional, at least when it comes to the economy and financial markets?
I think what's interesting is their outsized proportion of capital markets relative to their proportion of GDP. Now, in terms of GDP, they're not that huge. They are very large. They're the largest economy. But when it comes to capital markets, they're utterly dominant. And one of the things I always show is the MSCI All Country World Index pie chart, which shows you the breakdown by country. And the US makes up 65% of the global equity market. So utterly dominant. And to first order, the equity market is the US market. And it's been that way for over a century. And that's what I think is utterly exceptional about the US. Their liquid capital markets, their dominance in finance.
And if we accept that that's true, or has been true over the last century, why is it the case? Why has the US hoovered up this capital?
I think one of the things, certainly in the equity market, is how much dividend they reinvest back into the company for growth. And that's something they've been doing consistently and better than many other countries around the world. That's how you grow your capital market. Compare that with the UK, where we drain our companies of capital because we demand high dividends in our market. They can't reinvest that capital back into growth. So I think that's the primary difference and the reason for the US to grow more quickly in the equity market than elsewhere.
And I think it's not just in the equity market. Like the American economy itself actually tends to grow faster than other developed markets. So if we look back over recent history, since the 2008 financial crisis, America's real GDP growth on an annual basis has been around twice that of Britain and Europe and more than 4 times that of Japan. In that sense, at least, it's been exceptional. And in fact, America is the only country that has returned to its pre-pandemic potential growth path. And it's actually doing better than that. It's kind of 4 percentage points above what was predicted pre-pandemic in terms of economic growth, whereas pretty much the whole of the rest of the world is below trend growth.
And I think that itself, that success, breeds more success. Because if you imagine that you're some kind of research scientist or somebody who's a technologist or a coder Where do you want to work? Do you want to work in Silicon Valley, or do you want to work in the UK or Europe? Many people are flocking to the United States, or at least they were.
And that has huge advantages to the economy that captures this talent. There was a study a couple of years ago which showed that immigrants to America accounted for more than a third of US patents since 1990 and were involved in the founding of more than half of America's unicorns, like these billion-dollar startups.
And of course, it had all the benefits of being such a strong and vibrant democracy, which is stable rule of law, a legal system that was very reliable, and also favoured companies in that it very carefully protected intellectual property. And ultimately, it had a very strong defence, because having a very strong army ensures that you stay as a sovereign nation.
And one of the upshots of all of that is that America had very close allies around the world and got to design the global trading system to its own specification in large part. So we forget that now. America seems to hate the economic world order as it's been set up. But they built it, really, after the Second World War. Don't you think?
No, absolutely. If you look at all of the trade agreements globally and the institutions that protect them, a lot of these are agreements, institutions which the US set up after World War II. The US was pivotal in setting up organisations like the WTO. Previous to that, it set up the GATT agreement, the World Bank, the IMF. So now seeing them tear it all down is very odd.
I mean, it's really unfashionable to say it these days. But I don't think anyone or any country has benefited from globalization more than America. If you think about Apple's business model, like it literally stamps it on its iPhones, right? Designed in California, assembled in China. That's almost the perfect business model, I think, for a developed economy, because America captures the lion's share of the profit from this technology. Apple is the profitable company there. It outsources a lot of the negative externalities, like pollution, to another country. And it benefits from relatively cheaper labour abroad, so its own consumers can buy iPhones like at half the price it would cost them to make them themselves. How is that not ideal, right? I mean, there are downsides to losing manufacturing, and there are cities in America like Detroit which have been hollowed out, but that's another problem you can deal with, I would have thought.
And there was a lot of narrative around people screwing things into iPhones. Did you see those videos making the rounds from China on TikTok, which showed American workers with very sad-sounding Chinese music screwing all the components together in very large factory warehouses?
And I would say China had not made the portrait of American workers particularly flattering. Did you see?
No, that's fair.
They were all pretty grotesquely overweight, which I was like, that's a bit too far, China.
Yeah, that was a bit harsh. But I think it made a point, which is that, is this what America wants? Would American workers be happy doing that? Whereas, in fact, what will probably happen is if it was reshored, these processes would be automated. It wouldn't create more jobs for workers, necessarily.
Not unless you want to pay $2,500 for an iPhone. But just in terms of the really big macro picture over the last 30, 40 years, it seems that the US has sort of cherry-picked the very advanced, productive industries, and I'm thinking about finance and technology, and it's come to dominate them, and it's shorn itself of, in some ways, the burden of less advanced industries.
And okay, I can see that that has caused some problems. They have absorbed a lot of the excess capacity from China, for example. The dollar is probably stronger as a result of being the world's reserve currency, and that does make US exports less competitive. And manufacturing has collapsed in the United States, but it's moved into something which is more profitable for the average worker.
Americans have never been richer. Look at the stats, it's just true. But something's going on, right? There is a popular backlash to globalization, not just in America.
Yeah, I can see that if you are someone who works in a blue-collar job, then you do feel left behind because you haven't benefited from globalization. Your job's been outsourced somewhere else. And not everybody can do programming. You can't expect someone to move out to the West Coast off a production line in Pennsylvania.
But my response to this is, if you think globalization was bad for the average American, wait till you see deglobalization.
That's a good point.
So I think it's fair to say that in terms of financial markets and capital flows, the US has been exceptional, really. Do you see that changing? Is it like undercutting its own markets now?
I think one thing that won't change is the amount of money they reinvest back into their companies for growth. And that's disproportionately higher than it is for European companies, for example. And the ultimate result of that is higher equity growth. And I don't think that's going away. However, the engine of that growth is innovation and science and technology. Now, if it is the case that people are worried about going to the United States for conferences because their laptop's going to be confiscated, if it is the case that people are worried about their political views and whether if they make a social media post, it's going to affect their scientific career, well, that's not going to attract the best brains because these are people who want to express their beliefs, whether they're political or scientific.
Roman, before either you or I travel to the US, we have to wipe all traces of this podcast from the internet. Or we'll end up in El Salvador.
You know, I was thinking if we went to the US now, what would happen?
Well, if you look at some of the numbers, you could make the case that US tourism is collapsing. So I saw that the total number of overseas visitors travelling to America dropped 12% year on year in March. And that was before all the latest news. Visitors from Europe's falling even more, down by 17% year on year.
Now, I would expect that to reverse because at the moment people see news stories about people being held up at customs because of some post they've made or because of what's on their laptop. That'll eventually fade. What's much more worrying is the funding of research in the United States. For example, biomedical science is somewhere where the US has been utterly dominant. They've come up with a lot of the innovations which have transformed the pharmaceutical industry. And yet what we're seeing right now is politicization of spending on research. For example, cutting research on mRNA vaccines, which are truly groundbreaking.
It doesn't help when you've got a health secretary who is an avowed vaccine skeptic, really, does it?
It is shocking. I never thought I'd see that from the US. And just to put that in context, the National Institutes of Health in the US is the largest biomedical institution in the world. It provided more than $40 billion annually to health research, funded 300,000 researchers at 2,500 universities, and that was primarily in the US. So if you cut the research budget for the NIH, it's going to affect research for generations. Plus, if you're a researcher working on one of those grants, you'll be thinking, well, why should I stay here? Why not go to Europe, where they will welcome my research and where I can speak freely about my political views?
Yeah, there was a recent poll in Nature which found that of the 1,200 scientists they talked to in America, 3/4 said they were considering leaving the country. That would be a hell of a brain drain, which America would live to regret, I think.
And it's not just the NIH, it's the National Science Foundation, the NSF, where it's looking very likely that we're going to get very severe cuts. Now, that's going to affect the long-term development of US science, which feeds into their technology and feeds into their corporate profits. And that, I think, will take a long time to fix.
And it's not just these government agencies either. I know that universities are facing huge threats from the White House, which is threatening to pull funding unless universities change their campus policies around inclusion and equality and all the things that the Trump administration is annoyed about. And what's maybe most perverse here, Roman, is that we've heard so much talk about reshoring manufacturing and technology jobs into the US. That was happening, and it was happening at scale. With the bills that were passed under the Biden administration, such as the CHIPS and Science Act, such as the Inflation Reduction Act and the Infrastructure Bill, factory construction in the US had absolutely boomed. If you look at the graph, it's actually started to tick down now because of all the uncertainty. Arguably, what the Trump administration wanted was already happening.
And I just question, if you're a manufacturer in China right now, would you be thinking, oh yes, I'll immediately go to the United States and start a factory there? Or would you be thinking, well, what's the policy going to be next week? And even if I do that, will it affect my business in a negative way?
Yeah, if you're a business, you need certainty around policy, right? And you need that institutional framework of the US that you mentioned around law and good governance to persist well into the future. And there are, again, warning signs here that US institutions are having their independence questioned. Like, we've all seen it. But the big one, I think, is around the Fed. And there's a court fight going on at the moment, which is not related to the Federal Reserve, but could have big implications. So the Trump administration is in court seeking to sort of test a 1935 Supreme Court ruling that let officials government agencies be shielded from being fired by the president. And the immediate fight is around some officials at the National Labour Relations Board and the Merit Systems Protection Board. Might sound a bit obscure, but if the court rules that yes, the president has the authority to fire these officials, watch out, Jerome Powell.
And again, that would be a huge erosion of faith in the US fixed income market, because if the president can suddenly decide in a Truth Social post what should happen to US interest rates, then we're moving towards Turkey rather than what we'd consider to be a developed market.
It's weird, isn't it? Like, I've seen in Bloomberg, like, commentators who are sensible people saying the US is becoming an emerging market in terms of how policy is constructed.
Did you see the phrase Caligula capitalism? I thought that was...
I didn't, but I like it.
But look, we've been reading all the stuff that comes out on the social media platforms and the news, and that's kind of made us a little bit too cynical, I think, about the United States. I think that long term, it'll still remain the most liquid, deep market in the world. I think it'll go back to growth once we get over this period of uncertainty. And I think it's not good to overreact when you get this kind of news flow, because that's going to hurt your wealth.
No, I agree. It's hard to imagine the world where America isn't the biggest, richest country. And if that were to change, it would take a long time, I think. And also you need to put these things in context, right? We've had a sharp shock, in a way, through the Trump doctrine, which has led to massive moves in Treasury yields and the dollar. But if you look at the absolute level of these yields, it's not that unusual. In fact, they're lower than they were in February, right? It's just the pace of the move that has upset people. The other thing we've learned, I think, which is crucial in the last week, is that when the market really holds his feet to the fire, Trump folds.
And it was the bond market which changed his mind. And that's exactly what I thought would happen. That, ultimately, if bond yields spiked, it would be like Liz Truss. That would be what held him accountable.
I remember you saying that, and not for the first time, Roman, you've been proved right. I think it's also easy to read too much into sell-offs in the stock market. Like, we have seen stories about pension funds in Europe, particularly in Denmark. I wonder why. Greenland. But they're selling down or thinking about selling down US equity holdings. But these things take a long time to play out. And we're going from a position where the US was arguably overbought. Like you said earlier, it's like 65% of markets. Historically, it's more like 50% of global markets, isn't it?
And it doesn't always outperform. That was true even before all of these huge changes. If you look at the year-by-year outperformance of the US versus the rest of the world, it only outperformed in 55% of the years since 1975. It does tend to go through these long periods when it underperforms.
Yeah, it does look quite cyclical when I look at the data. So you get periods of 7, 8, even 9 or 10 years where the US will underperform. Notably, it happened in the 2000s, where the rest of the world outperformed following the dot-com bubble. I think we've just got used to the last 15 years where US outperformance has been exceptional. But that's a recency bias, right? Just because the US might underperform in the next decade doesn't necessarily mean it's the end of US exceptionalism.
Yeah, and I think it's also a symptom of success. When things are looking great, you think everything will always be fine and you can do whatever you want. And this has very clearly shown that you can break things quite quickly if you're not careful.
But at the same time, as we've just listed all these caveats and said, come on, it's America, they're going to be fine long term. Sometimes you do get regime shifts. Empires do crumble, and political decisions do matter. Right now, the hard data is strong. The US is adding a lot of jobs. Inflation has come pretty much back down to target. We've got a soft landing. But that is in jeopardy if policy decisions are bad or flip-flop about needlessly.
I think what's really critical is the next step in democracy, which is, will the US electorate see that this is a problem? Because at the moment, there's still a very strong vocal element of the United States electorate which is fully supportive of Trump, despite all the economic damage which is likely to occur. So the question remains, will democracy favour more strong economics, or will it go down the doctrinal route?
There was a meme going around on social media, which made me laugh, and I thought was quite illuminating, which was a kind of waveform of tariffs go up, tariffs go down, tariffs are announced, tariffs are cut. And whenever tariffs were announced, there was a guy with a little MAGA hat on saying, this will be good for jobs. And then the same guy, when it's cut, says, art of the deal. And that's basically Bill Ackman.
Now, you might have thought that the coterie of billionaires which surrounds Trump, for example, Ackman, but more directly, Elon Musk, you'd have thought that they'd see it was in their own interests to try and ensure that you don't get these huge negative impacts on the economy because it affects their wealth in the order of billions of dollars. But that doesn't seem to be the case. Maybe it's the case that it's not going to affect their lives if they lose a few billion. Whereas if you're a manufacturing employee in the Midwest, you bet it's going to affect you.
I think corporate America got too obsessed by the idea of tax cuts and deregulation without realizing that what's much more important for their success is the stability of the financial system and the American economy. And the really annoying thing is that Donald Trump and Elon Musk and Bill Ackman have done really well out of America. Like, the people to overturn the system should not be them.
Now, Michael mentioned the VVIX graph, which we put in our weekly newsletter. If you did want to learn more about markets and keep up to date with the important news flow, you can do that very easily. And of course, it's free. To learn more about signing up for our newsletter, just go to pensioncraft.com/newsletter.
Okay, today's dumb question of the week is, why would you ever buy another country's bonds?
I think I'd make a distinction here between retail investors, regular investors like you and I, Michael, and institutional investors. For a retail investor, I think the argument would usually be along the lines of, I don't want to be exposed to only my own country's bonds because I want diversification in bonds just as I get diversification in equity. What happens if I have a big sell-off in my domestic bond market because of a Liz Truss moment, and how do I hedge against that?
Yeah, because it's interesting that we usually cite the fact that developed market government bonds move almost in lockstep, right? They're very highly correlated. But then you get moments where that correlation breaks down, don't you? Where something extreme happens.
Now, if you are going to do that, you have to be really careful because bonds are generally quite safe. Their volatility is low. So if you buy foreign bonds as a retail investor, you're buying that currency risk unless the fund you buy is hedged. And it's notable that all the global bond funds on Vanguard's platform, for example, are all currency hedged for this reason, because you don't want to be taking the FX risk.
And a kind of related point there is if you buy inflation-protected bonds, in the US this would be TIPS, Treasury inflation-protected securities, what that's protecting you against is US inflation, right? I would have thought that if you're going down the inflation-linked bond route, you probably do want to buy your own country's bonds, or at least the country's bonds where you will experience the inflation.
Yeah, and personally, I never want to really go beyond my domestic market when it comes to safety, because firstly, UK gilts are getting pretty good yields at the moment. And also, I don't think they'll ever not be safe. I've got a lot of faith in the gilt market. So personally, I don't really buy the international diversification argument because I'd hold them to maturity anyway.
And there's a tax advantage in the UK where you don't pay capital gains tax on gilts. But this is all coming from a position of privilege, right? Where we live in a developed market with a government that has never really defaulted on its debt. If you're in a country where that's not true and you want to buy bonds, I think you've got to diversify.
Or if you live in a country with very low interest rates, which was the case in Europe until quite recently, then there was a yield pickup by switching to other countries' bonds, even after you currency hedge. So if you're an institutional investor, coming back to what I said at the beginning, then you will be looking at that every day as a bond investor. What would be the yield I'd get if I bought currency swapped Japanese government bonds or US Treasuries or UK gilts? Because you can literally fish in any market if you're an institutional investor.
And I think the textbook example here is Japan, where yields were so low in Japan, negative, that it's no surprise really that a load of US Treasuries are owned by Japanese institutions and the central bank. But as you say, you've got to outperform the cost of the hedge, right? And maybe that's no longer the case. And that's why we're seeing rumours of Japanese and other foreign investors in treasuries selling down their holdings, as well as all the political risk stuff. Volatility makes hedging more expensive.
Yeah, I guess it depends to some extent on the kind of hedge you've got, but that's certainly true. Another reason why you might want to do it, a reason why you have to do it, is because if you've got liabilities as a company in another country, you probably need to store some capital in that country, maybe from the revenues you've generated there. And that way you can pay your debts and also earn some interest on the stored capital.
So you've got dollar liabilities, and rather than just holding dollars, you'll buy treasuries that give you the best part of 5%.
Exactly, while you park the money. So I think for some institutional investors, there are structural reasons why they are buyers. They're just natural buyers of debt in other currencies.
And I'm sorry to get all economicsy to end this, but from a macroeconomics point of view, I think there's an accounting truism, which means that people have to buy foreign bonds and foreign assets. And that's because a trade deficit will equal capital inflows. So if the US is running a massive trade deficit, that means there are people with dollars that need to buy US assets. Doesn't necessarily have to be treasuries, but it probably will be.
And you don't have to look any further than China to see an example of that. That's why China buys so many treasuries.
Well, there was an era, wasn't there, where Japan had a massive trade surplus and all these dollars to park, and it spent it on like Hollywood movie studios and things, right?
But look, for China, this is a problem that's going away. If it doesn't have a trade deficit with the United States, because trade is impossible, well, they'd have to choose what to buy.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.